very warm welcome to you all to these proceedings in sunny Blackburn. It's the Accrol half-year results presentation. We're very pleased to update on our first half to the 30th of October 2020. With the recent acquisition of Leicester Tissue Company under our belts and the integration bedding in very nicely, the group, in our view, has never been better positioned to continue growing its share of the market in a profitable and cash-conscious fashion. Pleased to say we're all here in Blackburn, and the business has been operating throughout these strange times in great order. Despite the evident challenges, which I won't dwell on, the operations have performed extremely robustly. We're very proud of the team and how they've stepped up to the issues without any interruption, and Graham will talk to that more as we go. Very encouragingly, the gross and net margin trends in the business continue to expand. These are underpinned by further evidence that we're bringing to bear, both in the existing footprint in Leyland and Blackburn, but also the new acquisition in Leicester. Positive cash dynamics in the business have accelerated, and we're on a very sound footing in relation to net debt and balance sheet strength. That has been recovered for good under our stewardship, and this gives us confidence in announcing our intention to return to the dividend list in FY 21-22. The Leicester acquisition is already having an extremely positive impact ahead of our expectations, both in terms of the reception it's been greeted with from customers and in terms of the cost and efficiencies that we're driving out of the platform. Group margins are strong, the sales pipeline is very exciting, and we're highly confident we're on track to deliver at least in line. So I'll hand over to Gareth now to talk through some team developments and some detail on the half one fundamentals financials.
So you may well have seen our recent announcement on final appointment to the board, which is Richard Newman joining from the 1st of February. Richard joins from DS Smith. I've known Richard for many years. He was my finance director whilst I was running DS Smith in the UK and Ireland. The fact that we've been able to attract an individual of his calibre shows the aspiration that the business has. And also, an individual like that wouldn't join an organisation here if he didn't see that we were building a business of scale. The other key point I would make about the team is we've now got all of the right people in the right roles. Graham Cox, who you'll hear from in a moment, is Managing Director of the Tissue Division. I've known Graham, again, for about 15, 20 years in his time at DS Smith, and Mark Dewis on a similar length of time. These two individuals are exceptional operators, the best people that I've come across over the last 30 years. So the quality of people we've got in our organisation now is a group of individuals that can deliver a significant business of scale that we will all be very proud of. I'll give you some highlights on the half year. I'll pick, first of all, on the core revenue number. You'll see a slight dip. Two reasons for that. First one, we already announced in our full year results that we had a benefit with the first lockdown of about £3 million worth of revenue that was brought forward with the panic buying. That fundamentally impacted the first 2 months of this half year. And also about 75% of our volume is sold through discounters and Aldi and Lidl in particular. In the first lockdown, they were particularly impacted with the change in buying habits, etc. But I would like to point out in the second half of the first half of the year, volumes have strengthened. And as we've entered into H2, that volume demand has increased significantly. So we are very comfortable with our continued growth expectations across the business. It's also pleasing to see our margins continue to improve, just under 25% gross margin now in the business, up from 20%. And that is a combination of improving mix and price improvements across all of our customer base. And the result of this is an improvement in our EBITDA of just under 70%. But to be clear about our expectations, we talk about a 10% EBITDA return, but this group of individuals here has expectations of, and we've always talked about teen EBITDA returns. Graham will give a little more detail on the costs, which was, again, good to see them falling further. And the net debt position that Dan mentioned at the beginning is pleasing to see that continuing to fall. And as he said, we've now updated the market that we will be ahead of expectations on our net debt numbers. So some good improvements, but this is merely a staging post to where we expect the organisation to improve from this point onwards. So pleasing to see, but lots more to do. I'll now pass over to Graham. I'll just give you a bit more of a flavour of the operational improvements across the business.
Thanks, Gareth. So operationally, it's been a turbulent sort of 9-10 months. As Dan said, really pleased with the team. We've managed the operation well. We've continued to run 24 hours a day, 7 days a week, without any interruptions. And it's a great credit to the team that we have here. During that time, we've continued to focus on operational excellence. We've just completed the installation of an automation and a robotisation of our Blackburn facility. That's enabled us to take a further circa 60 heads out of the business, a 2 million investment, giving us a 1.5 million benefit to the business. In addition to that, we've installed a new IT system in the summer, and that has again allowed us to continue to remove costs. All through that process, we've been able to engage with our people and work and communicate, and that's led to a really positive engagement within the business. The business is very committed to continuing to develop careers for the people that are working in Accrol. By the end of this financial year, we'll have nobody that's earning less than a living wage. And I think it's really key that the structure of the organisation is about careers and enhancement of people and how they can contribute to the business. So very positive with what we've achieved, and further work to continue to do, but a really strong foundation to build from. In terms of cost, continued the cost-based reduction both in administration, but particularly pleased with the 20% reduction in distribution costs. Combination of looking at pallet fill, looking at the right stock in the right place and the right forward planning. Distribution is our second largest cost. So again, a big focus in this area, good to optimise, good from an environmental perspective as well. And then on the cash flow and net debt, working with our suppliers and our customers from a creditor's perspective. Most of our key suppliers are now out at sort of 90 days. And that's been done with limited credit insurance. And that's a real sort of testament to the quality of the relationships we have with them, and also the partnership that we're developing. And on a customer perspective, again, we've got a good range of sort of 14 to 45 days of our key customers. And we see that both of those areas are pretty much done now in terms of the release of that cash. And then we can continue just to fine tune from a working capital perspective. So if we want to, looking at sort of margin and looking at customers, we move on to the next slide. I think one of the core strengths of Accrol is its customer base. We have a fantastic customer base, and then when we add the acquisition of LTC to it, that just broadens it further. What is actually key is we want to service and supply as many customers as we possibly can in this retail environment. And the feedback we've had from the couple of overlaps in terms of LTC from Aldi and Lidl were both very positive. Aldi stating they were very keen to work with a much larger supplier as their business continued to grow. And I think what's essential as we go forward with this customer base, clearly as we come out of the pandemic and we go through this year and into next, the pound in every consumer's pocket needs to deliver real value. That's going to be a real key feature. And the broad range of customers from discounters to retailers puts us in an excellent position to continue to benefit that. And we're already seeing strong growth from the likes of the discounters, but also from some of the other key retailers. And as we push this forward, we'll be talking to further retailers, whether it be Iceland's and Spas, etc. But when we look at those key retailers, that's what's going to give us the growth opportunity as we move forward. So again, key driver, big market. We've got 16% of the total tissue market. Our core focus still remains focusing at the brands. So we want to take the share from the brands, the likes of Andrex, that are continuing to decline. And by offering a really quality value product in the marketplace, distributed through this channel of retailers, we're really confident with the growth expectations as we move forward. For those of you who have seen us present before, you will recognise this slide. We shared this when I first joined at the end of 2017, when the business was in a significant financial challenging period. And we talked then about our route back to a minimum 10% EBITDA business. And I'm pleased to say that you'll see that the progression into this first half of this year
has continued with further reductions in our overhead costs. Our people as a percentage of sales will continue to decline as our revenue grows. But I'm pleased to say that we see very line of sight now into a minimum 10% EBITDA return. And more importantly, that we see a clear route through to a teen EBITDA return business. Just because we produce toilet roll and kitchen towel does not mean to say that we don't deserve to make the right sort of returns that are appropriate for our shareholders and for us to reinvest back into the organisation. Over the next 6 months or so, and as we entered H2, we've seen further improvements in our material costs. And it's more around how we are using fibre and how we are combining materials to satisfy the customers. As Graham says, this is about us moving up and improving the quality of our products consistently. The mix of our work has changed dramatically over the last 2 years and has advanced particularly since Graham has been here in the last 15 months. So we are very confident about delivering a teen EBITDA business. And as we progress, this slide will change to give some aspiration of where we expect to get the business. So a good improvement again, but still more to do. I'll pass over to Dan now, just chat a little bit more on the headline numbers around cash and debt.
Thanks, Gareth. In terms of net debt and the overall cash position, very much committed to defending the strength of the balance sheet that we've recovered, whilst maintaining significant investment in the growth of the business. We also look forward to a couple of further acquisitions to infill on the product portfolio and potentially vertically integrate into paper production. But overall, we are committed to maintaining a very conservative ceiling in terms of leverage and net debt ratios. But as I mentioned earlier, and this is based on our confidence in the business's position and its current outlook, we're very pleased to recommend the intention to return to the dividend list in FY 21-22. It'll initially be a relatively token payment, but we're also committed to building that into a progressive sharing, probably on an adjusted EPS basis, that properly rewards shareholders with an income stream. I'll hand over to Graham now to give some colour on how the business's cash generation actually comes about and how the operations contribute to that.
Okay, as we said, we've made some really good progress both with creditors and debtors, as you can see, and I think we're very much at the sort of final point, more or less, on that. There may be a little bit more to do from a perspective, but equally, when we look at raw materials and working capital, clearly as we've gone through the latter part of last year, we increased our raw materials, particularly in front of the likes of Brexit. And we've now got an opportunity, along with the acquisition of LTC, to reevaluate and readjust that as we go forward into the first quarter of this year. And that should put us in a good position to continue our growth and be able to manage that growth from a cash position, both from a debtors and creditors perspective, as we move forward. The capital disciplines are going to be absolutely key, and we've got to this position. We want to make sure we maintain and protect the position. So we're confident with that as we go forward, and we become increasingly cash generative.
Just a few words on the integration of Leicester Tissue Company. We were very pleased to make this acquisition. It took us some time. We were very careful in our prep work and our diligence, but the initial findings, and I would stress we're only 7 weeks in, so it's early days, and we've had Christmas and a lockdown in between, but the early findings are extremely encouraging. We're very pleased with what we've found on the ground and behind the business. Don't worry, the detail on this page is really to evidence the rigour and control being brought to the acquisition and its integration. This is something we've all done many times before, but we have a tried and tested method to do so. We'll report in full colour on the LTC acquisition later in the year, when we've got a bit more trading period under our belt. But the key headlines from the first few weeks are all very favourable. It's been a very positive customer reaction across the board. The two crossover customers of Substance, Aldi and Lidl in particular, have served to strengthen and deepen the relationships we've got with those key partners. There's a deferred consideration element to the deal which attaches to the delivery of certain contracts. I'm pleased to say all those contracts have started up at revenue levels that we expect, and the drop through to EBITDA again on some pretty safe assumptions, are also expected to come through. So there was 13 million of revenue expected to be delivered and 3.1 million of incremental EBITDA expected as well. The other key stakeholder base, the employees that there's been Graham will talk more to it in a moment, but there's been a very warm welcome from the employee base in Leicester. But more importantly, there's a wealth of know-how down there that we can tap into across the group and bring back into the operations here in Blackburn and also in Leyland. But I'll hand over to Graham for some colour on that.
Okay, thanks, Dan. So yeah, just to conclude, I think from the integration piece here, as Dan said, this is a tried and tested process that we've done many times. It works. It provides the governance and the rigor to ensure the effective integration of the business. We're well down the path on it. Very successful so far, and as we said, the engagement with the teams and the people have been fantastic. The owners left on day one. We've already started to scale up the operation in terms of the assets that we had there. But 4 key lines in a well-purposed building, exactly what we expected. A small but very competent team. We completed a bit of automation that needed to be done, so the asset is exactly as you would start if you were building a greenfield. So very pleased with that. As well as integration, the key area then is the value creation or synergy generation. We committed the £1 million of synergies. The way we go about this is, again, a very structured and detailed process. We've done the discovery sort of phase. We've looked through, we found 55 different projects or work streams that are there to generate initiatives that will deliver a benefit to the business. What's really encouraging is those 55 initiatives go across a broad range of functions within both the Leicester business and within the Accrol business. So to give you an idea of a few of those areas, clearly there's obviously opportunities in terms of cost and alignment on procurement, making sure we leverage to the best price and the best terms, but also in things like logistics. 48% of everything we make in Accrol goes south of Leicester. So we will be looking to move, and we've already started the process of moving the right products to be made in the right location to optimise that logistics cost, which is our second largest cost. Clearly on the sales side, we've got further opportunities. We make facial tissue within Accrol. We've now been able to sell that facial tissue product through the Leicester portfolio. Likewise, the Leicester team have a very good and very strong tertiary brand offering. That works very well with the customer base, and that offering is being brought back into to the Accrol business. There's also opportunities from a fibre, from a tissue perspective, where we're purchasing clearly significantly greater tonnage. We've been able to leverage some opportunity there. We were buying better than the Leicester business. Not only that, but we've been able to support the Leicester business with our range of suppliers, and there's further opportunity to simplify that work mix. So I think overall we could say very confident it's delivering exactly what we expected to. Really pleased. We are only 7 weeks in, but the response of the team has been fantastic. The customers have been very, very receptive to it. We've well done the integration path, and we've got a really clear line of sight of the activities we need to do from a value creation synergy development. So very, very positive. Probably certainly one of the best acquisitions we've seen at this sort of stage of development.
We committed to deliver a minimum of £1 million of synergies as a consequence of the acquisition of LTC. In concert of that, the delivery of those synergies with the deferred consideration structure and the incremental EBITDA that drops through, the effective entry price of that acquisition drops to about 5.5 times. So we think we've got a very good asset. We bought some additional capacity we're already utilising across the group. So I think in financial terms, it's already beginning to justify itself. We'll just update on some of the key strategic objectives in front of us. I think as we're hopefully demonstrating, we're highly ambitious for the business at this stage. We think it's now underpinned with some really strong foundations. We can project some really strong growth off. We've got LTC under our belt, lots of work to do in terms of the integration, but we've also got strong growth in the core business here in Blackburn and Leyland, and we think we've got a clear path to leadership in the market as a consequence in private label. And with this, we think will come market-leading returns across the core tissue business. On the left-hand side of the diagram, that's meant to represent some of our ambition for the business. We think there's a revenue opportunity in front of us of 250 to 300 million in the midterm. With the addition of the LTC asset, we think we have capacity inside this business now, the order of 210 to 220 million. So with some small incremental capex, we can grow into that revenue potential relatively quickly and cheaply. Underpinning that is an intention to vertically integrate. We haven't formally come to this decision yet, but in principle we're there, and we're beginning to put some very detailed plans together about investing in a new build mill. And that would be the next step for us. Strategically, it would strengthen our supply position. It would also strengthen our relationships with certain key customers. And the financial case is particularly compelling as well. The payback on the gross capex would be around about 2 years, and on the net capex substantially inside that. So we think strategically and financially it's the right thing to do. And again, we're working towards a formal decision on that in the next quarter or so. On the right-hand side of the page is the plans we have for diversification, particularly of the product portfolio. We've got some exciting near-term developments, particularly across wet wipes, but we've also got key opportunities, we believe, in ancillary products such as feminine hygiene and adult incontinence. And we've been doing a lot of work to prepare our understanding of the market and how we would enter. We'd apply the kind of Accrol philosophy of lowest cost, disruptive product and value to the end consumer, and we think all three of those categories demonstrate those attributes, and we can go forward on that basis. And if you'd like to add some words, Gareth.
So yeah, just on the different products that we're looking to extend into. So wet wipes is an example where that is a product that is bought by the same buyers that buy our products. We'd only enter markets where we felt that we could have a point of difference. So around that market, it's real biodegradable wet wipe solutions. And if we find something that makes sense to us, then as we do with LTC, then we'll take the opportunity. We've got a team that's more than capable of and a bandwidth and to be able to cope with the group growing. That's why we've put this team in place in the first place. So really exciting times, but we've got some significant ambitions about what we're trying to do with the group going forward. It is rare in my mind in the UK that we've got a market that grows at 8% a year. The brands continue to decline at around 6%. With our acquisition of LTC, we are uniquely positioned with some excellent assets that are geographically well placed to take advantage of that continued growth. And if you also listen to Aldi and Lidl and Iceland and Morrison's about their expectation of growth post the pandemic, their expectation is double-digit growth across the tissue and kitchen towel lines. And we also know that the pressure on individuals' pound in their pocket post-pandemic is going to be significant. So we feel that we're in an incredibly strong position to continue that growth expectation. The operational transformation that's gone in the organisation, in many ways you need to see it to believe it. The automation of the Blackburn site, the completion of automation of the LTC business post-acquisition has truly transformed this business. We've gone from employing just under 700 people when I joined in 2017 to now employing just over 300 on a like-for-like basis. We've done that through automation. We've done that through IT upgrades. The business now is in an incredibly strong position to take advantage of that. The other key point, we are absolutely ruthless in our approach to capital and where we invest our money. Every pound we invest in the organisation has to deliver the levels of return that we and our shareholders would expect. And I said this at the beginning, but I truly believe this. Clearly, I am slightly biased, but I know we've got a world-class team. The individuals we've got across the organisation are exceptionally talented and are more than capable of delivering a business that leads quite nicely into the financial returns that we would all expect. I've said this earlier, and I'm not embarrassed of saying it again. We expect teen EBITDA returns from a toilet roll and kitchen towel business. We know that if we make great products, the consumer continues to buy them. And those sorts of returns are the sort of level that I think our shareholders deserve to get, and then will allow us to reinvest back in the business and grow in the right areas. So really exciting time. The next 3 to 5 years will be ones that we can all be very proud of, and ones that the team at Accrol are all looking forward to delivering upon. So at that point, I will stop and wait for questions.
And the first question we have is, can you say why you stopped supplying the AFH market, and are there any plans to return to it?
So I'll take that one. I'll also there's one other point as well I'll raise. The away from home market. So that is a market that the business was flying about £30 million when I joined. It just for everyone that understands what that market is. That is the pubs, the hotels, restaurants, which will use hand towels, napkins, that type of product. The long and short of it is we don't have any intention of returning to that market in the short term or medium term, for that matter. We came out of it because the asset base that Accrol had at that time that produced that product was incredibly old. It was poorly invested, and when you compared it to the kitchen towel, toilet roll, and facial tissue markets, the machinery that we had, it was just not anywhere near the sort of standard that we expected. And obviously, at the moment, that particular market has been decimated because of the pandemic, with the closures of many pubs and hotels. So we have no intention in the short term or medium term of returning back to it. Before I get the next question, I just wanted to cover one point, which I'm more than happy to answer any questions that come up on this, but I wanted to cover off as well the director share sale, which was made a couple of days ago, and in particular my share sale, and to cover off the background to that. So I've been here 3.5 years, joined in September 2017, came into a business that was in a significant financially difficult position, with very little time to turn the business around. It was probably one of the most complex turnarounds that certainly I've ever been involved before. It required a length and commitment of time that was significant. This isn't the first opportunity I had of selling some shares, but it does not show that my commitment is any different. I've sold a small percentage of my shares. I will keep the 80% of the shares that I've still got. And it does not show, in my mind, anything else other than my long-term commitment for the organisation. I have absolute confidence going forward. But at some point, senior leaders and managers in the organisations within AIM have to have the opportunity of selling some of their share options. Otherwise, we won't be able to continue to attract the right sort of talent and keep the right sort of talent in the organisation. So that's the background to it. I'm more than happy to answer any other questions. But I just wanted to cover that one off with everyone first.
I think the only bit I'd add to that is the team have bought a very significant stake in the business and continue to hold that, and certainly my intention to hold my position for the long term there. So the direct investment we've all made has been significant. I think between us we own more than 5% of the business. So hopefully that creates a strong alignment with the rest of the shareholder base.
Thank you. Leicester Tissue Company vendors previously built and sold a similar business to Sofidel and set up LTC 3 or 4 years later. Will they be able to do so again?
I guess there's different answers there. They as you mentioned, Tamsin, they did build Sofidel and sell it. Sofidel has thrived subsequent to that sale. It's a strong player in the market. In many ways, it's the market leader, and it remains so. So they sold the business, but it continued to thrive. They did set up Leicester Tissue Company a number of years later, arguably about 8 years after Amin had left that business. A lot of the strengths of Leicester are because all the know-how of Sofidel was invested into the Leicester project. So we've bought a business which is extremely lean, extremely well set out. None of the learning pains have gone into it. So we benefit from the know-how that Amin and Ayaz had input into that business. I spent a lot of time with Amin and Ayaz. They've both moved on to different phases in their career and life. Amin's a little bit older, Ayaz is younger, but I think they both have intentions of doing different things rather than re-entering the paper market at this stages of their career and life. And we have a fundamental non-compete that holds them out of the market for 3 years. I don't need to fall back on that. I think that the two prior points are stronger around the non-compete issue, but there is that legal protection there where we need to fall back onto it.
Thank you. In view of the impact of historical health and safety incidents to the company's share price, could you explain the type and severity of accidents currently being recorded?
It's everything from, so that the accidents reported in the presentation, for instance, that they are everything from a paper cut to a sprain. So it's every single accident of any kind in the organisation is recorded. Every single near miss in the organisation is recorded. So we have I was going to say, I think the couple of things. One is we create an environment where we encourage every single accident, every single incident to be reported. So I think getting to that position, we're very clear on that. It's very transparent. As Gareth said, the nature of them are cuts, a knock, a bump, etc. It's very, very minor, but again, we have the opportunity to root cause investigate and continue to improve that. The safety progression has been significant in the business. The safety culture continues to improve from where it was. There is always more to do. We're always relentless in terms of that approach, but it comes down to that combination of the right people, right engagement, the right behaviours. And it's something that myself and the rest of the team here have been used to, very high standards from previous businesses, and that's the expectations we've set here. So, no, on a very positive trajectory, but what's in the report, what's being reported is absolutely very minor, but it's really important that those things are reported so we're completely transparent internally and we can do all the investigations and prevent something else.
Thank you. Could you help us understand why you believe EBITDA is a suitable metric in a business where depreciation and amortization is such a material element of the business?
Well, the easy answer to that is that we don't view the other measures any less so than EBITDA. It's just a measurement that the markets have grown used to seeing from the organisation. As we progress, we share all of the numbers in a very transparent and open way. It's just the way that the market has tended to see the results from the Accrol business and many others within AIM or within publicly quoted organisations. So it's not something that we present because of some other reason. It's just the way it's been done for a number of years.
I think it's one measure we use internally as a proxy for cash flow. Depreciation is typically at the level of maintenance capex. Capex above and beyond that level is typically funding growth. So in this first half, there's 6 million of capex, but they're both to a degree one-off capexes. One was the institution of implementation of a new IT system. It was long overdue, but it's already delivering some substantial cost and revenue benefits to the business. And the other piece of significant capex in the half was the automation of this plant here in Blackburn. So we've robotised the end of lines and put some automatic conveying in. Again, it's very much a one-off capex, that one. So EBITDA is a proxy for cash flow. I think increasingly the market is beginning to look forward to our post-tax earnings next year and the year beyond. So I think I would think that is more likely to be the key valuation metric as we go forward.
Thank you. The UK annual market growth, as you say, is 8%, which is not that much. You seem to export only 5% of product. Could this not be increased?
I don't know what would be a lot, and if 8% growth per year is not a lot, but there aren't many markets that I know of that are bigger than 8% growth. Our expectation as a group is that we expect to grow ahead of that position. So last year it was 14.5%. So we expect our growth trajectory to continue. I think more importantly, in addition to that, we expect our margin to grow. Anyone can grow and not grow your margin. So we tie our growth expectations along with our margin growth expectations. With regard to export, kitchen towel and toilet roll average pallet price is about £186. You can't export things that are less than probably about £500 per pallet. So exporting or importing of converted toilet tissue is not commercially sensible. Whether we would go into external markets, that would be for a longer term thought process. What we do as we get to a larger group. But we're quite pleased with a plus 8% growth and continued margin growth.
Thank you.
I think sorry, Tamsin, that trend growth of 8%, we'd be very pleased to achieve it, and we think we're going to do better. But the tailwinds we've got from that are the exposure of the business to the discounter channel. Historically, it grew on the back of the discounter channel. Increasingly, this team has begun to penetrate the grocers, but with discounter style products. So we think that growth is happening. Graham was talking to the likes of Aldi and Lidl. Particularly if we enter more recessionary times, their businesses doubled, trebled in the aftermath of the GFC in 2008. They anticipate something similar as we go forward in the early 20s. So I think we're in the right place with the customers, and we can piggyback on their growth. And similarly, that 8% growth in private label, distinct from the GDP style growth that happens across the rest of the market, is coming because the brand is being displaced. So we are pressing hard to displace Andrex, and Andrex is in a degree of decline. So it's 6 to 8% a year in, year out, and it's probably accelerating. If you look at the continental European example, when the private label brand share gets to a 50-50 split, which is where we find ourselves in the UK now, it accelerates very quickly in private label's favour. Effectively, the brand capitulates. And if you look at the example in Germany, it's about 80-20 in private label's favour, 75-25 in France. So we think we've reached that tipping point, and that will power on our growth in concert with the customer growth being in the right place in retail.
I missed the timescale on you deciding whether to build an actual paper manufacturing mill, and would this run in conjunction with parent reel converting? And do you have any indication of the cost saving, benefit, margin contribution a mill would provide?
I think I said, we are hastening towards a decision on that. We'd like to be in a position to update the market formally on it before the financial year end, but there are a number of moving parts, so we're not able to commit to that. But our intention is of the order of that. The actual commissioning build period for the mill is 18 to 24 months, so you can extend the date forward on the build project by that degree. We're not in a position yet to give guidance on the numbers, so I'm going to hold fire on that one. When we come forward with the formal decision, we'll probably be in a position to give some financial shape to it. But the internal maths we've done, the financial case for it is extremely compelling. And we would, back to Gareth's point on capital or discipline, we wouldn't be choosing to invest in that area if we didn't think there was extremely quick payback on it. Wasn't quite sure how to dissect the question about parent reel, but we would never move to a fully integrated position. So the paper production would represent initially about 50% of our requirement that we then convert. So the mill we're looking at is 65 to 70,000 tonnes. We at the moment convert 120,000 tonnes that we buy that parent reel tonnage from the open market at the moment. As we grow, the proportion of in-house production versus bought-in product would decline to probably 35-65.
The only thing I would add to that, the work that we've done on tissue grade simplification from 75 when I joined down to in effect 6 means that we could be in a position where we would be manufacturing potentially 1 grade on this machine. So the operating performance of the machine would be, if not the best in the world, one of the best in the world. Very rarely do you get a machine that just makes 1 grade, 1 size. Because of the work we've done in simplification, that's allowed us to take a real competitive advantage if we eventually progress this.
Thank you. The LTC acquisition sounds very positive on a number of fronts. What are the annualised synergies on actions already taken versus the 1 million target?
Again, I don't know.
I think we announced that there would be we talked about £1 million of the synergies. Graham, in his presentation, has shared that that we've got we're 7 weeks in, so just be mindful of that. But I've been involved in 30 acquisitions. I know that everyone tells you this is always the best one. This really is the best one. That I've never come across one that's gone so well so far. We've identified 55 different work streams. Clearly, 55 different work streams is a high number. And that's what gives us confidence that as the RNS states, that about delivering at least £1 million synergies that we've announced. Clearly, again, once we've completed that piece of work, we will then announce to the market in due course what we feel it will benefit the wider group going forward.
I think, as Graham said, though, a lot of the synergies are not just in Leicester; they're across the wider business. So, we're taking a lot of learnings from Leicester, whether it's in tertiary brands or selling our facial product into the Leicester customer base. Some of the know-how they've got in production has been helpful as well. So there's lots of benefits that hit across the group rather than just in Leicester.
How does Accrol see the B2C working? Will this not affect retailers and also add to the cost base? Low-cost products need to be picked, packed and dispatched in small numbers direct to end users. Am I incorrect?
I think that's the right-hand side of our strategy slide deck. I think you've got to be mindful of what product is. We look at a variety of different adjacent products, some of which would make sense to if we were to move into them to be a B2C market. And the ones that we look at in that particular area wouldn't directly impact our core toilet roll and kitchen towel businesses. So we expect to look at a variety of different products and different areas and different routes to market. I expect us to challenge and look at all avenues just to make sure that as a group we are progressing in the right direction. Some of which we will never progress, but we will continue to look at them and ensure that we've got the right strategy going forward. So it just depends on what the product is.
The retail landscape is clearly shifting, and underneath the retail landscape, how the retailers service their customers is changing. You've got dark stores growing up in America. They'll probably come this way as well. I think we've just got to be alive to what that means for our business. Clearly there's benefits to everybody if we work together in partnership with the retailers. So for instance, we deliver to an RDC. The RDC delivers to the stores bring it to the front of the store, the consumer drives to the store, picks up a big box and takes it home. There are elements of that. If we work in collaboration with the retailers, we can take cost and complexity out of the situation as well. So we don't look at it just as a threat. There's definitely an opportunity with the right partners to go forward, whether that's B2C or B2B2C.
Thank you. When are you looking at introducing your new products, feminine hygiene, incontinence, wet wipes, and will these be manufactured by yourselves?
I won't particularly talk specifically about them, but we trial a number of things. So, for an example, would be pocket packs. We sell a number of pocket packs. We don't currently make them ourselves. But for us, it's a nice route into a market. If we see that the demand is there, we would then invest behind that demand. So it's a less risky investment process. So we'll find out whether there's a demand for a particular product and then invest behind it.
But I mean, the other aspect of that is if we can buy a small foothold in the market that we can then build on that business and invest behind it in terms of bringing in additional manufacturing capacity. Once, as Gareth says, the demand for the product is there, then that's something we'd look to do. But we're also looking to make sure we bring differentiated product to market. We're winning in our core tissue business because we're bringing really good product. In the case of the toilet paper, it's super soft, and that's what customers value. So we have to come forward with differentiated product to make sure we can penetrate the market to a scale that counts.
I see you currently have no women on your board of directors and only one woman in senior management in Catherine Robinson. When can we hope to see a woman with suitable skills join the board, please?
I think board development is something we are planning. We have a succession and recruitment program running. I think there's also Lindsay Marsh, who's a key component of the team as well as Catherine. So Catherine's not the sole lady in the business, and a number of other senior managers who are female as well. So I think it's a function of the turnaround. It's just happenstance that's what's happened, and it's a turnaround team that kind of has delivered the turnaround. It just happens we're all blokes, but it's not. We want to add the right expertise to the board. Bringing some retail know-how, bringing some marketing know-how onto the board is a priority for us.
All I would add, I know it was a board question, but if you look into our organisations and our factories, part of the positive nature of the automation that's going on in our organisation, the technical capability that's required to work in these types of businesses means that we're starting to attract a real cross-section of society, and more young women are coming into the organisation as engineers, shift management roles, production management roles, and by doing that, and if I compare that to previous jobs and businesses that I've been involved in, it's a really positive sign in Accrol, and that then across society will flow the right sort of talent throughout organisations. It may take some time, but if I look at just the quality of young people that we've got in the organisation now, I'm really proud of what we are doing and the difference that we are making. Graham mentioned about the fact we have no one paid less than the living wage by the end of this financial year. That's something that I am really pleased about. We don't expect to have, I don't believe that pushing a pallet around is a career. And we want to make sure that we reward people accordingly. And also manufacturing is an environment where young people want to come and join and get involved in, because actually it's bloody exciting and it's good fun. So I know it wasn't a question about manufacturing, but.
Thank you. Accrol shares look more than fully valued. What's the case for investing more now?
Well, I hold 10 million of them and haven't sold any, so I'm very happy to hold them on the basis that we can discuss valuation all day, but I believe there's plenty more to go. There's a very strong return coming out of the business. It's got an increasingly dominant position in its marketplace, so I'm happy to hold my 10 million shares.
And just this is we've completed the turnaround. We've now got a business that we can really build upon. We've got foundations and individuals throughout the organisation that are the right to grow a business of real scale. This is just the start of what we're trying to achieve. So I wouldn't have convinced this gentleman to come and join me if he thought this was it. So we're not. This is Richard Newman wouldn't be joining if he thought, do you know what, I'm just going to join a bog roll business in Blackburn. That's not what we're doing.
Thank you very much. That's the end of questions. Do you have any closing remarks?
I just would like to thank everyone that's joined the call today. I wanted to reiterate again the fact that we are excited about the opportunities that we have in the organisation. I do think that we are in a truly unique position in the market. I know someone said that 8% growth wasn't that much, but I think finding a market that's growing at the level that is in the UK is really exciting. It's a product that has shown, despite pandemics, despite recessions, is required every single day. And I know that when we're getting it right and producing the right sort of products, that the growth aspirations for us are significant. The adjacent markets that we're looking into are equally exciting, and the sorts of returns that we can consistently deliver are significant and are teen EBITDA levels. So I hope that many of you will either continue to invest, and the ones that aren't will invest, because this is just the start of what we're going to be doing as an organisation. So hopefully you'll join and enjoy the journey.